Imagine you fall behind on a credit card bill. It's stressful. Your credit score drops. You get calls. Maybe a letter from a collections agency. It's bad, but it's contained. It stays in its little box. Now imagine a different kind of debt. One where missing payments doesn't just hurt your credit score. It lets the government skip court entirely, reach directly into your paycheck, take a slice of your tax refund, and even take a piece of your Social Security check when you're 70 years old. No judge, no trial, no jury deciding if it's fair. Just a letter, a 30-day countdown, and then your employer is legally required to start sending part of your paycheck to the government before it ever reaches your bank account. That debt already exists. 40 million Americans are carrying it right now. And for years, the most painful part of it was switched off. Starting in 2026, it got switched back on. If you have student loans, or you know someone who does, what you're about to learn could be the difference between sleeping fine tonight and opening a letter 6 months from now that changes your life. Here's the belief almost everyone carries around about debt, especially student loan debt. If I can't pay it, the worst that happens is my credit score takes a hit. I'll deal with it eventually. Everyone has debt. It's fine. That belief made a lot of sense for a very specific window of time. From 2020 to early 2026, the consequences of falling behind on federal student loans were basically frozen. Collections paused. Garnishment paused. For a few of those years, interest didn't even build up. Think about what that actually does to a person's brain over 5 straight years. Imagine a smoke detector that's been sitting on your ceiling, beeping occasionally, and every single time it beeps, absolutely nothing happens. No smoke, no fire, no emergency. After the 40th false alarm, you stop reacting. You might even take the batteries out. Not because you're careless, but because your brain is a pattern recognition machine, and the pattern it learned over and over was this alarm means nothing. So an entire generation of borrowers learned a lesson that felt true, but was actually temporary. Missing payments on this loan doesn't really hurt. That's the trap. Your brain doesn't update beliefs the moment a rule changes. It updates beliefs slowly, usually after something painful forces it to. Psychologists call this the normalcy bias. It's the same reason people keep living near a river that's flooded twice before. The mind assumes tomorrow will feel like yesterday, right up until it doesn't. For 5 years, falling behind on a student loan felt like nothing. No knock on the door. No garnishment notice. Nothing. So millions of people quietly stopped paying. Not because they're irresponsible, because the system trained them for half a decade that there was no real urgency. That training just expired. Let's break down exactly what changed, in the simplest way possible. Think of a federal student loan like a rope tied between you and the government. As long as you're making payments, that rope just sits there, slack, not doing anything. But if you stop paying for about 9 months, roughly 270 days, the loan is now officially in default. And once that happens, the government doesn't need to go to court to pull on that rope. Can pull directly. That pulling has a name: wage garnishment. The government tells your employer, take a slice of this person's paycheck before it reaches them, and send it to us. Your employer has to comply. It's not optional for them. For 5 years, that rope existed, but nobody was allowed to pull it. That pause started in 2020 because of the pandemic. It got extended again and again. Borrowers got used to a world where the rope was just decorative. In January 2026, the government sent out the first wave of warning letters. Then more every single week. The rope is no longer decorative. It's active. Here's the part most people don't realize, and it's the part that makes this genuinely different from 2019. In 2019, if you fell behind, there were a dozen different income-based safety nets you could climb onto. Plans where if you earned very little, your required payment could legally be $0 a month, and the clock toward forgiveness still kept ticking. Think of it like a financial trampoline. You fall, but something underneath catches you and slows your descent. Several of those trampolines have now been removed. One of the most generous ones was struck down entirely by a court. The replacement plan that's taking its place doesn't offer a true $0 option anymore. Even someone earning very little is required to send in a token payment every single month, just to stay current. So picture two versions of the same person falling behind financially. Version 1, in 2019, they hit a rough patch, their income drops, they apply for an income-based plan, their payment temporarily drops close to nothing, and they technically stay in good standing while they get back on their feet. The system has cushioning built in. Version 2, today, that same rough patch happens, but several of those cushions are gone or shrinking. The remaining option still requires a payment. Miss enough of those, and the 270-day clock starts ticking toward default a lot faster than people expect, because they assume the trampoline was still there. They reach for it. It's not where it used to be. That's the actual shift. It's not that one missed payment suddenly destroys you. It's that the soft landings disappeared right as the hard consequences came back online, at the exact same time. Two forces, used to canceling each other out, are now both pointing in the same painful direction. Let's make this concrete with a simple, relatable story. Picture someone named Maya. She graduated, got a decent job, and was making her payments fine for years. Then her hours got cut. Her income dropped for a stretch. In 2019, Maya's move would have been obvious. Call her servicer, switch into an income-based plan, watch her required payment shrink down to something she could actually afford, maybe even close to nothing for a few months, and keep her loan technically current the entire time. She rides out the rough patch, gets her hours back, and switches back to a normal payment plan later. No harm done. Now picture Maya going through that exact same rough patch today. She still calls. She still wants to do the responsible thing. But the menu in front of her looks different now. The plan she remembers her older sibling using doesn't exist anymore. The replacement plan still asks her for a payment every month, no matter how little she's earning. If she doesn't act quickly, or if she assumes things still work the old way and just lets a few months slide while she figures it out, those months start stacking up. 9 months of stacking, and she's not a little behind anymore. She's in default. The rope just got pulled. Maya didn't do anything reckless. She did the same thing a responsible person would have done in 2019. The floor underneath her just isn't where she thought it was. Here's where this gets interesting from a psychology standpoint, because this isn't really a story about loans. It's a story about how humans relate to invisible threats. There's a concept in behavioral economics called hyperbolic discounting. It's a fancy term for something very simple. Humans are wired to care way more about right now than about later. A problem that's 3 years away basically doesn't exist in our brain's risk calculator. A problem that's due Friday feels like a 5-alarm fire. Student loan default is the perfect storm for this bias, because the bad outcome from missing a payment doesn't show up immediately. You miss a payment in January. Nothing visibly explodes. You miss another in February. Still nothing. By the time something visible happens, like a letter in the mail, months have already passed, and your brain has fully adjusted to this is fine, because nothing painful punished that belief yet. This is the same psychological mechanism behind people not checking their bank balance when money is tight. Not because they don't care, but because not knowing feels less stressful in the moment than knowing. Avoidance feels like relief. It is not relief. It's a loan against your future peace of mind, and that loan comes with interest too. Here's the deeper truth wealth-minded people eventually learn, usually the hard way. Money problems rarely arrive as a single dramatic event. They arrive as a slow accumulation of small, ignorable moments, and then one day the consequence shows up all at once, looking sudden, even though it was building the entire time. The garnishment letter isn't really sudden. It's the final visible step in a chain that started 9, 10, 11 months earlier, the very first time a payment got skipped and nothing immediately bad happened. This is also why financially secure people tend to treat small recurring obligations, a loan payment, a bill, a subscription, with more seriousness than the dollar amount alone would suggest. They're not just protecting that specific payment. They're protecting their own pattern recognition. They know that the moment missing it is fine becomes a belief you actually hold. You stop noticing when the rules underneath that belief quietly change. And the rules just quietly changed for 40 million people. There's a related idea worth understanding here too, sometimes called change blindness. It's the reason you can stare directly at a photo, have something in it slowly altered, and completely fail to notice, as long as the change happens gradually enough. Our attention is built to detect sudden differences, not slow drifts. A loan policy that flips overnight would get noticed immediately. A loan policy that gets dismantled piece by piece, over a couple of years, court ruling by court ruling, plan by plan, slides right under most people's radar. Nobody experienced the safety net disappeared as one event. They experienced a dozen small news stories, most of which felt easy to skip past, because each individual headline didn't sound like it applied to them personally. That's exactly how meaningful financial risk tends to build in real life, not just with loans, but with almost everything. Rent creeping up 5% a year doesn't feel like anything in any single month. A subscription you forgot about doesn't feel like anything in any single charge. The danger was never in any one moment. It was in the sum of all the moments you didn't check. So what do you actually do with this, especially if you're someone with federal student loans, or you're close to someone who is? First, treat your loan status like a smoke detector you test, not a topic you avoid. Most people don't actually know with certainty whether their loans are current, delinquent, or already in default. That uncertainty feels safer than checking, but it's the most expensive kind of not knowing there is. 5 minutes logging into your loan servicer's account is one of the highest leverage 5 minutes you can spend this month. Second, understand that in default and behind on payments are two very different stages, and the gap between them is your entire opportunity window. Being behind is uncomfortable. Being in default is when the rope gets pulled. There are real, legitimate paths to get a loan out of default before that happens, things like rehabilitation, where you agree to a string of affordable payments to restore the loan to good standing, or consolidation, which can roll it into a fresh loan with new terms. These aren't loopholes. They're built-in exits. But exits only work if you walk through them before the door closes, not after. Third, if money is tight right now, don't assume the old, "I'll just get a near-zero payment plan" move still works the way it used to. The replacement plans behave differently. Look at what you actually qualify for today, not what a friend qualified for 3 years ago, because the menu has changed. And fourth, here's the mindset shift underneath all of this. Silence from a creditor is not the same thing as safety. For 5 years, silence and safety happened to overlap, and that overlap quietly trained millions of people to confuse the two. They're not the same thing. They just looked the same for a while. The single highest return action available to almost anyone listening to this isn't a clever investing trick or a side hustle. It's simply finding out with certainty exactly where you stand on any debt you've been avoiding looking at. Clarity, even uncomfortable clarity, is always cheaper than a surprise. There's an old idea that money problems are really just math problems. They're not. They're attention problems wearing a math costume. The borrowers walking into trouble right now aren't, for the most part, people who can't do math. They're people who, completely understandably, stopped paying attention during the exact 5-year window when paying attention didn't seem to matter. The rules went quiet, so they went quiet too. That's not a character flaw. That's just how human attention works. We tune out threats the moment they stop producing pain, and we tune back in the moment they start again, often a little too late to act calmly instead of urgently. The system has changed back. The rope is live again. And the people who check now before a letter arrives get to choose calmly on their own schedule with real options on the table. The people who wait for the letter don't get to choose at all. The choice gets made for them. So here's the only question that actually matters after watching this. Do you know right now, today, exactly where your loans stand? If the honest answer is, not really, that's not a reason to panic. It's just the most useful 5 minutes you could possibly spend before you do anything else today.